All right, today we are diving into a huge milestone for Plasm. The yield engine has officially blown past the $50,000 mark in pure, delivered profits. Now, this isn't just some vanity number, it's a massive proof point for the protocol's health, especially with the Day 78 event just 5 days out. So let's break down why this is such a game changer for Plasm's defense system.
Look at that. $50,012. That's not just a number on a balance sheet. It is the validation of Plasm's entire design. It's the definitive proof we've been looking for that a truly sustainable, independent defense engine is humming along in the background, working 24/7 to secure the protocol.
So, what's the real story behind this number? Let's unpack the journey that got us here and really dig into why this milestone sends such a powerful signal about Plasm's future.
Okay, first things first, we need to be super clear on what claimed profits actually means. This isn't theoretical paper gains. No, this is a running tally of delivered yield, real actual capital that has flowed directly from the DEXFI bonds into the protocol's defense pools. It's money in the bank already at work.
Now, the context here is what makes this so incredible. Just 12 days ago, on day 62, we were sitting at about 45 grand. In that short time, the market went completely insane. We're talking a 50% crash followed by a 100% bounce, extreme fear across the board, and major token unlocks. And through all of that chaos, the yield engine didn't just hang on, it actually thrived. And this slide just lays it all out, doesn't it? In those 12 wild days, the engine cranked out over $4,700 in yield. That averages out to almost $400 every single day, flowing right into those defense pools, no matter if the Plasm price was going up, down, or sideways. So, how is that even possible? How can it be so consistent? Well, this leads us to the absolute core concept here, yield independence. Let's look at exactly how this engine works, because it's completely separate from the token's market drama. Here it is, plain and simple. The Plasm token price, that's all about market sentiment. People buying, people selling. But the bond yield, well, that comes from a totally different place. It's generated by trading fees in the underlying DEXFI vaults. The two are not connected. They're completely decoupled.
And this is the secret sauce. It's so powerful because it's counterintuitive. That high market volatility, the very thing that can cause fear and selling pressure on the Plasm token, often leads to more trading in those underlying vaults. And what does more trading mean? You got it, more fees. And more fees means more yield. So the very stress that hurts the token can actually become fuel for its defense. So this all creates this beautiful self-sustaining cycle. It's a flywheel. The bonds generate fees, those fees flow into the USDC defense pools, the USDC pools then fund the daily buy and burn, which permanently shrinks the token supply, and this loop just repeats day in and day out, giving Plasm this constant, reliable defensive pressure.
Okay, so once you understand that loop, it's really important to get the difference between the two types of fuel powering this whole system, because not all defense pools are built the same. You've basically got two fuel tanks. On one side, you have the USDC pools, which are filled by that constant bond yield we've been talking about, and on the other, you have the E-share pools, which get filled by protocol entries. Their behavior, well, it's like night and day.
The USDC pool is the sustainable core of this engine. Think of it like a self-refilling gas tank. Because it's constantly getting topped up by that $400 a day in yield, it can be used aggressively, day after day without ever running out. It is a perpetual defense machine.
The E-share pools, though, are a totally different beast. They're a finite resource. Don't get me wrong, they are incredibly powerful. But when that capital gets used for a buy and burn, it's gone. It needs new people to enter the protocol to get refilled, which makes it dependent on outside factors and way less sustainable for long-term defense. Okay, so with this proven, sustainable engine firing on all cylinders, how are we looking for the big Day 78 event? The date that's been circled on everyone's calendar. Let's project this strength forward for the next 5 days.
So at our current average of around $400 a day, we can pretty safely expect the yield engine to generate about another $2,000 between now and the start of the Day 78 event.
That means the buy and burn USDC pool, which is already over $22,000, is on track to be north of $22,500 by the time the event kicks off. That is a serious war chest of stablecoin-backed defense. And what does that actually mean? Like, what can it do? Well, to put it into perspective, at a token price of 30 cents,
That USDC pool, by itself, has enough firepower to buy and burn around 750 tokens every single day. That is daily, automated pressure, all funded by outside yield.
So let's zoom out. What's the real takeaway here? What is this $50,000 milestone truly proven about the fundamental design of Plasm's entire economic engine?
This right here is the bottom line. When the market gets stressful, most protocols have to bleed their treasuries dry just to defend their token price. They're depleting their resources. Plasm's design is the exact opposite. The very stress that causes volatility can actively generate more yield, strengthening its treasury when it needs it most.
That is the real yield advantage in action. This $50,000 milestone is so much more than a number. It's the proof. The sustainability of this engine isn't a theory anymore. It's a demonstrated, battle-tested fact. And it's ready for whatever comes next.
And that's our look at the Plasm Yield Engine milestone. Before we wrap up, just the usual friendly reminder, this is all for educational and informational purposes only. Nothing here is financial advice. Always, always do your own research. Thanks for tuning in.